I'll cover off in three broad areas. One, a quick business overview in terms of our performance, top line, and occupancy numbers. Then I will share with you a quick review of markets, what the situation is currently, and then a snapshot of looking ahead where we stand and how we have prepared ourselves for the current market uncertainties. So, a quick business overview to start with. Uh, in the third quarter of 2020, which is the third quarter of our fiscal year, we recorded a revenue of 29.4 million Singapore dollars. This is 11% dip from the same period, third quarter 2019, where we had revenue of 33.1 million. This essentially reflects the impact of COVID, which began to be more visible in third quarter. Referencing 9 months year to date, it's fairly stable with only a small dip of 1% at revenue of 96 million versus 97.3 million for the same period last year. If you look at the financial occupancy, which is based on leases signed and paid, PBWA, the purpose-built worker accommodation segment, recorded 87.5% occupancy for the 9 months of this year to date. This is a dip of just about 2% versus last year. Sorry, an increase of 2% versus last year, where purpose-built worker accommodation actually saw higher occupancy this year versus last year. Now, the numbers, 87.5%, include a new asset, which is Bukit Minyak, Westlight Bukit Minyak in Penang, which opened only in the second quarter of last year for occupancy and was ramping up during that period. Okay. In the student accommodation segment, we recorded an occupancy of 67.1% for 9 months year to date. This is quite a marked difference versus the same period last year, where we had average occupancy of 84.8%. These numbers also include the new assets that were taken on last year, which was essentially the Dwell East End Adelaide that had completed development at the beginning of the year, and Dwell Village Melbourne City, which completed its asset enhancement, adding beds as of the end of the first quarter last year. So, but if you look at the pie charts on the right of the screen, you will then see where the difference is. In terms of 9 months year to date, the revenue by business segment, you will see that for this year, worker accommodation contributed 71% of total group revenue. This includes Singapore and Malaysia, whereas the purpose-built student accommodation PBSA segment recorded 28% of group revenue. This includes UK, Australia, Singapore, and to a smaller extent, the US, where we manage 6 properties under a private equity fund. Compared to last year, worker accommodation contributed 65% of group revenues for 9 months 2019 versus PBSA contributed 34%. So you can see that for this year so far, worker accommodation has been holding up, given the fact that the revenues are fairly flat. Worker accommodation, you can see, has contributed more, while the student accommodation sector has seen more impact from COVID for the year to date. If you look at revenue by country, you will see that in effect, Singapore has done better year on year for 9 months year to date, whereas UK and Australia have dipped. Malaysia has climbed a little bit, marginally by 1% in terms of contribution proportion, and the US has also held stable. So in a nutshell, for 9 months year to date, the revenue has been stable with only 1% decline. But if you look at the third quarter, you will see that COVID impact has increased with an 11% reduction in third quarter revenue year on year. Now, this was mainly due to the student accommodation segment, where the UK student accommodations have been affected, and also particularly in Australia, Dwell Village Melbourne City in Melbourne, whereas the Adelaide property has not been as much impacted. I'll go into more details about this in the market overview. But these are primarily where we saw occupancies affected by COVID-19, beginning in second quarter and continued through the third quarter. This impact has been mitigated by revenue contributions from new assets. Dwell Archer House in Nottingham, the UK, which we added to our portfolio at the tail end of 2019, began contributing revenues more significantly over the year. And also from management fees that we have received from new assets where in Singapore, where we secured a tender to manage JTC worker dormitories. These are factory converted short-term dormitories for the 6 months plus 6 months extension option. So in terms of financial matrices, we have implemented capital management and cash conservation measures since earlier this year, and our current position is quite stable. Total assets valued at 1.5 billion against borrowings of 0.7 billion. So you can see our net gearing ratio is at 48%, and this has come down versus 51% previously. Interest cover is at 3.8 times, and this excludes lease liability requirement under FRS 116 accounting and bank facility fees. Currently, our cash and undrawn committed facilities are 191 million. So we're in good cash conservation mode. We have adequate reserves with an average debt maturity of 7 years. One of the benefits and strengths we have coming into this situation is the group has built a diversified business portfolio over the past years. And this is a diversified business portfolio across 2 asset types, worker accommodation and student accommodation, and across geographies. Our worker accommodation is in Singapore and Malaysia, and Malaysia has grown to a point where it's contributing 8-9% of group revenues over the year. And in the student accommodation, where we started in the UK and Australia, where then we added on US, Singapore, and Korea over the years, it is now a significant part of our portfolio and balances it. So in total, you will see that we have $1.8 billion in asset under management, including managed properties that we don't own, or joint ventures where we own 45% of Mandai and 55%, and 55% of Westlite Papan in Singapore. The total capacity is 65,133 operating beds across 33 operational properties. We're in 16 cities in 6 countries. And this gives us some stability in a situation where certain markets are more impacted, other markets are less impacted, and this has helped us balance our performance over this year. Accommodation growth profile, especially for those of you who have been following us in the past years, you will see that we have continued to grow our portfolio quite aggressively over the years. In 2018, there was a dip in our portfolio capacity as one of the Singaporean worker accommodations, the lease expired and we returned that land to the government. But we have quite successfully replaced those bed counts in 2019 with new acquisitions and developments completed. This year, in 2020, despite the COVID conditions, we have managed to continue to grow our portfolio. In September, we secured a tender from JTC to manage 4 of the quick build dormitories. I'll explain a little more detail about these quick build dorms in the following slides. And that has, in an asset-light way, without capex and development costs and only minor retrofitting costs, we have secured the management lease for 6,400 beds in Singapore, which has created additional revenue stream for us. We have additional pipeline that will continue to expand our portfolio this year and next year. So let me then go into the business review by markets. Let's talk about Singapore first. In Singapore, because of the COVID conditions, I think there's been a lot of activity as well as questions about redefining the specifications for worker dormitories. And I'm sure many of you in this webinar are aware of that. Let me start by explaining the current demand and supply dynamics and what we see coming up based on government announcements. So currently in Singapore, there are 352,000 work permit holders in construction, marine shipyard, process sectors, oil and gas, who by MOM regulations must stay in approved housing, such as purpose-built workers' dormitories or purpose-built dormitories. This does not include retail, service, manufacturing staff or Malaysian migrant workers who can choose to live in HDB or shop lots, private housing, but also may choose to stay in a worker accommodation, purpose-built dormitory. Their employers may choose to put them there. Okay, so actually the committed demand is 350,000, but additionally there's another 400,000 or so migrant workers who could choose to work to stay in the dormitories, versus a current supply of about 210,000 beds in purpose-built worker accommodation, and then supported by more temporary types of worker accommodation, about 150,000 of those in what we call factory converted dorms or dormitories built on construction sites, as well as other permissible housing approved by MOM. Now, the government has said that they intend to densify the existing dorms in order to better manage COVID and future anticipated pandemics. And what they have announced is that they will build 60,000 short to mid-term capacity to allow some dedensification, while in the longer term, they create an additional 100,000 longer-term purpose-built dormitory beds. Of the short-term beds, 25,000 are what has been called the quick build dorms, and this is where they are piloting the new specifications announced by MOM and MOH. Additionally, there's about 25,000 temporary use of currently underutilized state properties like schools and places like that, factories, and then an additional 10,000 that they will allow employers to build at construction sites called construction temporary quarters, CTQs. Now, as I've mentioned earlier, and you may have caught in the news, out of the 25,000 quick-built dorms, about 10 of those have been built, of which we have secured the master lease for 4 of them from JTC, amounting to 6,400 beds. So in effect, we have about the management lease on 30% of that capacity already. And we see further opportunities and will continue to aggressively pursue those opportunities. The longer term arrangements are still being discussed. What the specifications of those are, that's unclear at this point. But what we do anticipate over time is that the government will continue to manage the supply of beds in order that the demand and supply is well balanced. So into a bit more detail, in the worker accommodation space in Singapore, as I mentioned, we've successfully secured a tender to lease and manage 6,400 of these quick build dormitory beds. The first of this has commenced operations in late September, and as of 31st October, we have a physical occupancy of 35% and committed leases for approximately or close to 90% of the 1,300 beds at Westside Kranji Way. The remaining 3 QBDs, we expect to commence operations by this year and at the latest by January, first quarter of next year. We continue to enhance our pandemic management capabilities. In fact, we have had a good spate of the past weeks of 0 cases in our dorms, and now is the time that we have to be even more vigilant to ensure that that continues to be the case. Currently, financial occupancy remains stable. But we are seeing that employers have been impacted by knock-on effects of the circuit breaker and COVID management activities, and we are seeing slower collections and delays in receivables. So we do anticipate that payment and collection delinquencies will be higher, and this is one of the reasons why we have taken precautionary measures to enhance our cash reserves. We are in ongoing discussions with government agencies for to understand what the new purpose-built dormitory specifications will be and how that will impact us, as well as the implementation plans and timeline on existing dorms. And as mentioned earlier, we will continue to pursue opportunities. I think, given how we have managed our experience in managing the COVID conditions, we are well placed to be considered for these opportunities. Across the border in Malaysia, in our dormitories located in Johor and Penang, to date, we have no reported COVID-19 cases in our dormitories, which is currently 30,700 beds. Yeah, 7 properties, 30,700 beds. Financial occupancy continues to be stable as employers put their workers in and don't really want to be moving their workers around at this point. So financial occupancy is very stable. We continue to be very vigilant in safety measures, and we have contacted and are working closely with local authorities and employers on this. In Malaysia, what is interesting is that they have actually instituted an amendment or approved an amendment to the Workers' Minimum Standards of Housing, which requires employers to put their workers, their migrant workers, in good quality housing. Now, this amendment kicked in effectively from 1st September, and the JTK, which is Malaysia's version of MOM, Manpower Ministry, have given employers until 31st December to comply. So from January, non-compliant employers are liable to be fined. We are in the process of certifying our properties with JTK that they fulfill the requirements under the new act. We anticipate no difficulties there. So with this expected growth in demand, we have resumed development of 3 additional blocks. That development had actually started pre-COVID. We paused it for a while during the CMCO, and given that it is already development in progress, we have resumed the development to add 3 additional blocks and about 3,600 beds to next to our existing Westlight Tampoi asset. This is expected to complete by first quarter 2021 in good time for the increased demand due to the implementation of the amendment. So we're quite optimistic for Malaysia PBWA, of course, subject to COVID conditions and the lifting of CMCO. We do expect that demand will be robust. Moving on to student accommodation, let me walk you through our situation in the 5 markets where we have a presence. UK, where we have the largest portfolio, has been quite impacted. And as COVID situation continues to be quite rampant in some cities more than others, we continue to see an impact. So occupancy in third quarter, which is normally already the summer lull, was lower, impacted due to an early lease termination offer which we implemented in the second quarter. Because universities had closed their on-campus programs, students were not required to stay within the city of their study during that time. And for the understanding and supporting our residents and retaining goodwill for our brand and relationships with partners in that market, we offered an early lease termination in April last year, allowing students to terminate their lease early, starting May. So the impact of that was on the low end of our anticipated band of 3 million to 4.5 million. It came in at 3.1 million. And that impact has become visible in May, June, and July. So it affected third quarter revenue numbers. Moving forward, currently situation, we do see some gradual lifting of travel restrictions and resumption of on-campus activities during the third quarter. However, the COVID situation remains very fluid, and there's ongoing action management measures with current scaling up of reported COVID-19 cases. Cities such as Manchester, which is a prime city, one of the busiest cities after London, continue to be quite impacted. Demand from international students, a bit of uncertainty there. There is growing interest and demand, which we detect for the UK especially. However, bookings are uncertain because many international students are still uncertain about timing of university program resumption. So we do see some interest growing back, but hesitance in committed bookings at this point. But domestic demand remains robust, and research from various parties show that domestic tertiary education demand in UK is strong. For this period, to secure leases, we have implemented flexible leases that allow students to book now, but if necessary, to defer their stay until the travel is lifted and the university programs on campus are resumed. So we do see occupancy gradually recovering across our UK assets in cities like Nottingham, Liverpool. Uh, they're quite healthy, but in Manchester, where the outbreak is continuing, unabated, that is still quite impacted. In Australia, on the top right hand, you will see that universities have begun to effect blended and on-campus programs in Adelaide. So it's a tale of two cities for Australia for us. Adelaide is recovering quite nicely, and we do see a trend of increased bookings and occupancy. Students are returning, mainly domestic at this point, but also some internationals. But Victoria, Melbourne, is just emerging from its second lockdown, and demand for student accommodation is only now beginning to slowly climb back. So in Australia, we have been impacted more in Melbourne, less in Adelaide. But there is a silver lining beginning to appear. We've recently announced plans for a travel bubble between the countries, between different countries such as Singapore and Australia. We do expect international student demand to recover gradually. In Singapore, we have been affected by the outbreak as few international students arrived in Singapore this year. We were quite fortunate to the extent that students that were already in Singapore by February mainly chose to stay in place rather than go back to their home country. So our financial occupancy has not been too badly impacted. But during this period, we have had to reduce our bed capacity at Dwell Seligi, our single student accommodation in Singapore, from 332 beds to 240 beds, in compliance with Singapore Land Authority directives, and also to implement safe living measures, safe distancing measures within our dorms. Occupancy rate in third quarter was compressed, beginning to dip, mainly due to travel restrictions and also because the Singapore government issued fewer foreign student visas during this time. As you may understand, the Singaporean government during this time has tried to conserve tertiary institution spaces for Singaporean students who could not travel abroad to study. Okay. In South Korea, this is a property where we hold 55% of the equity in the property in a joint venture with other partners. And it's a smallish property in a new emerging student accommodation market. This property was ramping up throughout 2019 and was still in ramp up stage in the first quarter of 2020. In Korea, the universities stopped their exchange and language programs, which was the main source of our occupancy up to date. And so we were not able to attract new international student occupants. To try and balance the effect, we have refocused efforts during this time to target PMETs, the local PMETs. We do see as some normalcy is beginning to be seen, we do see greater interest from international students in Europe, South America, etc., beginning to come. In the US, Actually, we have performed better this year than last year in terms of occupancy and financials. The assets have been less affected by COVID-19, mainly because our US assets cater to domestic American students, interstate and intrastate. So occupancy has remained fairly healthy despite the uncertain COVID-19 situation. Okay, so coming to a close, let me share what we are doing in terms of maintaining our stability and sustainability during this time. So, in fact, the group's business has been disrupted by COVID-19, and we see that up to this point, mainly in the student accommodation, while the worker accommodation has provided a balance so that our 9 month revenue to year to date has been flat rather than badly impacted. So we're quite stable for the 9 months year to date, mainly worker accommodation supporting student accommodation impact. But additionally, our financial performance has been mitigated by various elements such as government subsidies, not only in Singapore, but in all the countries where we have a presence. We have tapped into government subsidies where available. Bank moratoria has, in terms of our capital payments, has also helped us in terms of cash flow management. And the low interest rate environment has actually reduced cost of business in that area. We have also taken very many necessary preemptive measures. Of course, we have enhanced our management and operational efficiencies. So while we do have to increase operating costs for COVID management, we've tried to streamline that as much as possible. We've looked at how we can reduce our spend and our costs, defer discretionary capital expenditure so as to conserve cash during such uncertain times. At the same time, we have looked for and seized opportunities to enlarge our portfolio and revenue streams prudently through asset-light opportunities, such as securing the 4 master leases with JTC to manage additional 6,400 beds. Moving ahead, the company is well placed for the uncertainties. We are prepared for further headwinds. We do anticipate that there will be, while vaccines are being announced and there's growing confidence in the marketplace for normalcy coming not too far in the future. We are prepared for headwinds until that time. But what's important is really, given our diversified portfolio in asset type and geographies, a balance between student accommodations and worker accommodations, we're quite confident in the fundamentals of our business and the fact that both asset classes are very resilient with the demand that is still robust. And especially in the student accommodation, we believe the pent-up demand for international and high-quality tertiary education will have a quite strong comeback. So in summary, that is where Centrum is. So that brings me to the end of our briefing presentation. We do have a few slides to outline our portfolio, but I think I can skip that unless some of our guests today want to see a detailed breakdown of our portfolio.